Honest facts, dynamic conversations, and powerful financial strategies that will help you craft a blueprint for your future. Welcome to We Money Talk with the founder and CEO of We Alliance Wealth Advisors, Terry Wheeler.
Inflation has been in and out of the news recently. You may have heard about it in discussions of food prices or cost of living adjustments to Social Security or the Federal Reserve. I'm Patrice Sikora with your host, Terry Wheeler, and his guest, Gabe Rodriguez. So, Terry, what do investors need to know about inflation, and why do you call it the silent tax?
Oh, good morning, Patrice. This is a topic that is really hitting home right now because we're seeing all the headlines in the news with inflation really hitting highs that we just haven't seen in recent decades. So it's been in that 2.5% range for so long. They forgot that it can get bad, and it's been in the 6 to 8% range, depending on the stat you look at. I mean, the government gives us one stat, you go to the grocery store and you know it's a little different statistic.
Yes.
So we call it the silent tax, though, because inflation is effectively the same exact effect as a tax. So if you have your taxes go up by 10% and you make $100,000 a year and they're going to take 10% more, you have $10,000 less. If inflation goes up 10%, your 100,000, you still have it, but it's only going to buy 90,000 worth of goods. So inflation has the exact same effect as taxes. The government very well knows this, and they play a game with inflation in order to effectively tax people. And they do that in a way that relates to the national deficit, which we'll get into in a moment. But taxes and inflation do the same thing to you. It gives you less purchasing power. So ultimately, that's why we call it the silent tax. And it can be a deadly silent tax if you go through a period like the 70s, where your dollar was basically cut in half.
Oh, I remember those days. I don't know if you do, but I do. Yeah.
I was growing up. I didn't care then.
All right. So, what's causing inflation all of a sudden to be such a concern?
So we all have kind of heard about all the money being printed. So, and I'm going to share my screen here to show you a couple things. When we look at inflation, it's caused by several things, but one of the big ones is the government printing money. And when the government prints money in order to pay for things like COVID, to pay off people's student loans, to do all the things the government is spending money on, all the immigration issues, sending money overseas, we don't have that money. They're just creating more money. So as they create more money, they reduce the value of every dollar that's in circulation. Now, this chart that I have up here, I'm going to describe to the listeners. Those on YouTube can see it, but it shows how the dollar has really, since 1913, come down to a fraction of what it was worth just 100 years ago. So it's worth literally pennies on the dollar. Now, we're going to look at some products with Gabe here in a few moments, and that will really tell you in more detail. It'll bring it home, so to speak, with products that we buy every day. But the printing of money and the spending problem the government has is what's causing our inflation. And one of the big benefits the U.S. has is the U.S. dollar is the currency of the world. So as we deflate our dollar, it doesn't just affect us, it affects the global economy. Because our inflation, if it's held by another country, U.S. dollars are held by another country, then they are paying us back with dollars that are worth less. That's good for the U.S. government, and that's why the U.S. government likes inflation. It's bad for other countries, and that's why we're putting at risk the U.S. dollar being the currency of the world. So inflation is a complex subject that we can see in simple terms when we just look at the effects, but why it happens and what's going to happen next can be quite complex.
Talk to me about the Fed. What's their role with inflation?
So the Fed's job is to control inflation. So their mandate is they're supposed to be keeping inflation. Now they're targeting about the 2.5% range. Now, how they do that is they control inflation primarily by raising interest rates. So if they raise interest rates or they pull money out of the system, I mean, they do tightening of the fiscal policy, so they actually take money out of circulation, When they do that, that causes interest rates to go up, but it causes inflation to go down. So we've seen that in real time over the last 18 months, where we had interest rates rise at the fastest pace during our lifetime. And it was all because inflation was very quickly getting out of control. Now, the challenge is the Fed wants to control inflation. That's their mandate. But the US government has trillions of dollars of debt now. So we are the biggest creditor that owes the most money in US dollars in the world. So if interest rates go up, the US government has to use more of our annual budget to just service debt. So the US government has a vested interest in keeping interest rates very low. And if they can keep inflation higher than interest rates, then they can gradually inflate away the national deficit. The headlines don't say that's what they're trying to do, but that's the recipe they did after World War II. And that's the recipe that we believe is going on right now. They actually want inflation.
Well, what could they do? I mean, okay, we've got the debt. If rates rise too much, the US could actually, well, as a sovereign country, wouldn't go into bankruptcy, would it?
So sovereign countries have gone into bankruptcy for sure. The US government has even devalued its dollar before. It wasn't that long ago, back in the 70s, where the US actually went off the gold standard. So in the old days, the US had to have gold to back every dollar. They couldn't manipulate things like we're used to today. But since they went off the gold standard, we have what's called a fiat currency, meaning nothing backs it, just the US government's promise to pay you back. So we're just a creditor. That's all that backs our US dollar. There's no assets there that protect it. So because the government can now manipulate it, the politicians have really become addicted to printing money. And they feel like they can spend money on anything and everything, and budgets don't mean anything in Washington anymore. So they haven't had budgets for years. So ultimately, the US dollar, we believe, is really already gone over the cliff, meaning the politicians aren't going to wake up all of a sudden and just start budgeting and start being fiscally responsible. Even if they did, the national deficit is so large right now, inflation is going to happen because the government has to keep interest rates down, or all of our national budget will just go towards servicing our debt. So we're in a precarious position that's going to take some time to get out of. And the easiest way for them to get out of it is to, let's just imagine we have 70s style inflation again. So in 10 years from now, let's just say our dollar is worth 50 cents on the dollar. That's what happened in the 70s. If that happened now, then our national deficit is basically cut in half from a real sense. And what I mean by that is it's only going to take 50-cent dollars to pay back the national deficit. So it's cheaper for the government in the form of goods and services that they have to give up in order to pay back the deficit if we have a lot of inflation. So it's in the government's interest to have inflation that is higher than the amount they have to pay toward their national debt.
Well, that's all wonderful for the government, but what about the common folk?
Yeah, it's actually bad for both. I mean, the government's hands are tied now. They've boxed themselves into a corner where they don't really have the tools they used to have to manipulate. They are ultimately causing something that is going to be very bad for the common folk, meaning we're all going to end up where, unless our salaries go up enough to keep up with inflation, we're going to effectively be making less and less every year. And those on fixed income. So think about retirees that don't really have inflation adjustments other than a diluted one for Social Security. Their effective purchasing power is going to drop slowly over time, and then might wake up in 10 or 15 years where it's a fraction of what it's worth today.
Now, is this a new problem, or have we been dealing with this really off and on forever?
Yeah, so that, as this chart kind of shows, it's a forever problem. But I'm gonna be quiet for a moment. I probably won't be quiet. I'll interject, but I'm gonna let Gabe kind of give us a little history lesson as to how to bring this down to the everyday consumer. Meaning, what do products cost? How does the effect? What's the effect of it? So, Gabe, you can run with it.
Yeah, and I think overall that's what people want to know is just how much the extent that prices have increased over the decades and over the years, and just how much it affects their purchasing power. So what better way to show that than with some real life examples of some goods that people buy, daily or every day. So I put together some examples of some goods that we'll take a look at and kind of open up the discussion. But I picked 4 dates on purpose, dates that were meaningful to Terry and I. So for those of you that are watching on our YouTube channel, you can see the slides. For those listening in, there's pictures here of my grandma. And the reason why I posted them or put them up is because she's 104. She turned 104 years old last June. She's on her way to her 105th birthday this coming June. And the pictures here on the slides are her celebrating her 104th birthday. So there's one with her cake, and it has the 104 candles on it. And then one of her drinking her favorite beverage, a Corona, to celebrate her birthday. So really what we're looking at is just how much these prices have increased over the long run. And so the first data point I have really is 1919, and that's significant because that is the year my grandma was born. The second one I kind of wanted to take a look at. Well, Terry, you're older than me, obviously, but I wanted to look at what the prices were during your birth year, 1968, and then for me as well, being in the younger generation, and then kind of comparing that to today's prices. So the first example I kind of wanted to walk through is Terry, I think something that you can relate to, having kids, candy bars.
I don't even need kids to relate to that one.
So if we look at 1919 prices, the cost of a single candy bar was 3 cents. And for Terry, the year that you were born, 1968, it increased to 5 cents. And the year I was born, 1992, it went up to 50 cents. Now, fast forward to 2024, and we're at $1.78 and rising.
And they're smaller. They're smaller, Gabe.
Yeah,
that's
there's
true.
Something. What do we call it, Terry? Shrinkflation.
Shrinkflation. Yeah. And I remember, Gabe, for the candy bars, I used to have a paper route when I was a kid, and at the end of one of the streets was a 7-Eleven. And we would always collect, because by those days you went and knocked on the door and collected your 75 cents for the local paper. And we would always stop collecting and go to 7-Eleven, and we would buy candy bars for 25 cents, and we would play video games for 25 cents. Now the video games are, I think, about $1 for most of them. If you go to Dave & Buster's, it's even worse than that. And candy bars are $1.79. And I've seen them at, if you're going in and out of a gas station, I've seen them as high as $2 and $3. And for some reason, I still buy them. I have a little bit of a chocolate problem.
So what I'm getting at here, if we look at 1919, the cost of a single candy bar, to 2024, it's about a 6,000% increase in prices. Now, Terry, I wanted to show you your year, 5 cents. It's about a 3,500% increase from 1968 to 2024, which means people born today, when they're your age 55, if things continue the way they are, they'll be paying over $60 for a candy bar. Can you believe that?
No.
Can you imagine paying $60 for a candy bar?
I can't, but if I was around then, which I probably won't be, I would probably be buying them still.
So case study number 2, I wanted to compare this to something that pretty much everyone buys, even those that may still be work from home. Gas, cost of gas. So in 1919, it was 25 cents per gallon for gas. And in 1968, 34 cents per gallon of gas. 1992, in the year I was born, it hit $1.13. And then today, 2024, the national average is $4.50 per gallon. But for those that may be in California, like we are, I remember back in 2023, there were a couple of times where gas hit as high as $6 or above $6 a gallon.
Yeah,
So I
that's
think we can
crazy.
kind of all relate
Yeah.
to
Yeah, I
that.
remember as a teenager when it was $1 a gallon, and my mom and everybody just thought the world was over. Like, how on earth can you pay $1 a gallon for gasoline? And it's crazy. It's hit $6 now.
Yeah.
So don't tell me what that's going to be when my kids today are
It's electric
55.
vehicles then, remember? It's electric.
Yeah. All right. And then you got Costa Homes, it looks like. I remember
Yep.
this one too.
Last but not least, cost of homes. So the median home price in 1919, $5,626. Fast forward to 1968, 24,000, just shy of 25,000. 1992 increased to 121,000. And then fast forward to 2023, the national median was 417,000. Now, Terry, we talked about this a couple of years ago, and you remember I was trying to buy my first home. So this one kind of really hit home, pardon my
Yeah.
pun, for me, because I put a couple offers on houses and they just continue to keep going up and up.
Yeah. Yeah. That was back when cash was king. And it seemed like the only people who actually got their offers accepted were if you were buying cash because BlackRock and everybody else was buying up rentals. I remember it well. Just like a trip down memory lane because I remember as a kid, I must have been 7 or 8 years old, and we literally moved across the street in one house over. And it was to buy a $40,000 house, which it was such a huge decision because I think our house was probably 28,000 or something is what it sold for. And it was a major financial move for my mom. And this house was a little bit bigger and it had a pool, which of course my brother and I were telling her all the reasons why she should be buying it. And I remember moving where we're literally just like taking a couch and we're walking it across the street. It was in hindsight, it's the funniest thing, but it was a major upgrade in our lifestyles. But it was a $40,000 house, which we thought was just over the top.
And remember, too, interest rates on mortgages during these times.
Yeah. 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 You had interest rates. I don't remember what the interest rates are admittedly back then, but I know they used to be much, much higher. We think interest rates are high now, and they're actually very competitive compared to historical numbers.
Well, I'm not going to use any ages here, but when I bought my first place, the interest rate was 14% on the mortgage.
Oh, so we hear those stories, and I admittedly did not um, go through a period like that where I ever had those kind of rates on a home. So what was the feeling like, Patrice? Like 14%? Like, did you just have to have a huge down payment, or how did people even do that?
And that's a good question. It was so long ago, I don't remember.
Well, I guess
Gabe,
if they were
stop laughing.
$40,000 houses, then
It
then
was
your
a
payment wasn't as much. But
it was a $45,000 condo,
wow,
and it was a 14% interest rate. I don't think I put much down. Maybe that's why the interest rate was higher. But this was the years of these were the years of the stagflation.
yeah, no, I mean, looking at charts, I see them. It's just it's different to live through them than to study it. It's just like the 70s with inflation being as bad as it is, which I lived through that, but I was a kid. So it didn't really affect me much. I didn't really realize what was happening. But I look at it in today's dollars and to think that everything that we have, like all your savings, could be cut in half in 10 years from a purchasing power. If you don't position your portfolio to adjust for inflation, that could be absolutely devastating.
And the question becomes, how do you do that?
Yeah. So let's talk about that for a second. So traditionally, there's a lot of different inflation hedges. So you've got houses up here. Real estate is a traditional inflation hedge, of course. One of the best actually over the long run, but they're slow adjusting. Even the stock market. Stock market often gets hurt pretty badly by inflation initially. Now, why? We talked earlier about the main way to combat inflation is rising interest rates. So if interest rates go up, the value of your cash flow, which is what stocks represent as future cash flows, goes down and the stock market crashes. But over the long run, stocks do adjust for inflation. So it is a good traditional inflation hedge, so to speak. We have some new entries into the market. One is inflation adjusted treasuries. Now, the problem with inflation adjusted treasuries is the government manipulates the inflation numbers. So having something that is earning interest that is over and above what inflation is works. But inflation adjusted treasuries are we're lukewarm on them because of the manipulated nature of them, meaning the government leaves out key things like energy when they do some of their inflation numbers, and that's a big problem. So Gabe's going to go over one of our favorite strategies in a moment, but I want to introduce one last new entry into the inflation market that will cause a lot of strong feelings one way or another, and that is cryptocurrencies. So just for fun, I went onto AI this morning just before we did this, and I said, what are the top 5 ways to battle inflation? And I wanted to see what it would come up with, and it came up with all the traditionals, but number 5 was cryptocurrencies.
Crypto.
Yeah.
Interesting.
Yeah, it's not something that we use aggressively in portfolios by any means, but having a few percent in a portfolio actually it would have been the right move for the last 10 plus years. It performs better than AI in the last 10 plus years, but it's a very high risk, high return type one. But the thought there, the movement behind cryptocurrencies and Bitcoin in particular is that as the US dollar is being abused and the value is deteriorating so rapidly, the idea behind the movement of cryptocurrency was we want a currency that cannot be manipulated by governments of the world. And if that takes its place as the new digital gold, which is where the first kind of hurdle would be, and that's a lot of people will argue whether or not that's happening now. If that happens, then the value should continue to go up, and it's much more powerful than gold because gold is very hard to maneuver or spend, whereas with technologies that are already in existence but are not yet mass adopted, you can spend money. With Bitcoin, you can just spend just like you're spending a Visa, and that's already happening in some countries that have adopted this as its currency. So we don't want to talk too much about crypto today, but that's an interesting new one. And then we have some indexing strategies that we like that really are a bond alternative. So think treasury or inflation adjusted treasuries, but a different way to get interest credited, because when rates are too low, you're just not making enough with traditional interest. And we think interest is going to stay low. So indexing strategies that are done creatively can be powerful.
All right,
So
Gabe.
what's one of your favorites, Gabe?
Yeah. So this group called the Nexus really have been really big innovators in the space, and like you said, Terry, they use indexing strategies to really combat and help fight inflation. So there's 250 indexes out there. A lot of people know the S&P 500, the Dow Jones, and the Nasdaq as indexes. But a Nexus really works with 23 of the best indexes. And one of my favorites happens to be the Schiller CAPE Index, which is offered through the Nexus products. So the index was developed or created by Dr. Robert Schiller, a Nobel Prize winner. He wrote a book on kind of the strategy involved, but it involves sector rotation and really looking at the 11 sectors in the business cycle market and really dialing it back down to what 4 are going to perform in the future. And really he looked at it from the standpoint that if we could focus on the 4, they would be able to beat the stock market hand over hand. So he's been very successful in his design and something that Nexus has innovated within their products. So that tends to be my favorite for helping to fight inflation. And how about you, Terry?
Yes, the key with that one is it has been able to give real returns over and above what inflation has run pretty consistently over the long run. So year to year, it varies, of course. Another one that they've come up with more recently is with a group called Loomis Sayles, who's been around since the 1920s. They, along with Loomis Sayles and Massachusetts Institute of Technology, MIT, they kind of took a science-based approach to create an index with global assets totaling about 44 different assets. And the way this is utilized is squarely to tackle this problem. That's another one that we believe is going to be very powerful to fight inflation and looking at today's credit ratings. And it's a newer index, so it hasn't been around for 20 years, but they can back test it because it's truly an index. It looks like it should be a very powerful tool. So we like to use that as part of a fixed income portfolio. So it's a bond type replacement, not a stock market replacement, but it should be able to give us real returns over and above whatever inflation is running, which if we end up in the 70s again, that's going to be very important because we can't have our money be cut in half. So those are two that we like. There are several strategies though. So we mentioned the more traditional real estate. We're going to talk in actually the prior episode, we talked about income is king. And income is king. One of the strategies is really looking at real estate debt. And I would refer you back to that episode to learn more about how that can give you a good return. But that's another way that you're typically going to get inflation plus additional return. So you're getting what we call a real return. What I mean by that is if you're earning 8%, but inflation is 6%, your real return is only 2%. And that's really the number that matters. So we don't want to just keep up with inflation. We want to grow your money. And that's what most of the strategies that we'll talk about in a variety of these podcasts will help you do.
Terry, how can listeners reach you if they've got some questions?
So they can reach us just at our website for the financial firm is www.weriaadvisors.com. Or just reach out to us. Our telephone number is 916-325-0130. We'd love to hear from you. And anything we can do to help, we're here for you. So pleasure talking with you again today, Patrice. And inflation isn't the fun one, but it has to be addressed. We have to battle it. And thank you, Gabe, for joining us today.
Thank you guys for having me.
It was a great discussion, both of you. Listeners, follow this podcast to learn about more and, of course, share with others. And thanks for being with us.
Thank you for listening to We Money Talk with Terry Wheeler. Be sure to click the follow button to be notified as new episodes become available.